Hello friends, welcome to another episode of Market Views. Each month we discuss trends we see in the markets, and on a quarterly basis it's a discussion between Hiren, Alok and me for generally asked questions or fears that investors, friends and family have in their minds for the market. This quarter we would be discussing what as we enter 2024, the fears that many investors have. So we'll try and address that. Before that, I want to wish you a very happy 2024. Wish you a very joyous, prosperous and happy 2024. 2023 has been a year of surprises. There were lots of talks about US going into recession, which didn't happen. There was China trade, which was a very short-lived one. However, Nifty did really well. Nifty did a return of about 20%. The small cap index did about 50% plus, and the mid cap index did about 40% plus. With that, the Indian market capitalization touched a mark of $4 trillion, and now it's only fourth, following in the United States, China and Japan in terms of market cap. We are lucky to have Hiren here because with a market experience of since the 1990s. Hiren, most people fear that after such a stellar year, there can be a year of consolidation. Do you see that for Indian markets in 2024?
So, Himani, thank you. And first of all, I also wish all our investors and friends a very, very happy new year. You know, it's become quite fashionable given you just mentioned that the Nifty was up 20 and the small and mid cap each were up between 40 and 50%. So it's quite natural for investors to have the fear of heights, and it's almost kind of become fashionable to be very cautious at the beginning of the year after such a big move, right? You also mentioned that many experts had predicted a US recession. People were very bullish on the China opening up trade. None of that really panned out as expected, and there are always limitations of trying to predict. So with that caveat, I would say, well, could the markets consolidate? It could. In any bull market, we should remember that corrections are part of it. But to assume that just because we've had a reasonably strong year, the next year has to be weaker is really not borne out by data. And I'll give you two statistics, right? In the last 10 years, from 2013 up until 2023, there's only 1 year that Nifty gave negative returns. But I'd like to jog everybody's memory back to the bull market of 2003 to 2007. And let me give you some data. In the calendar year 2005, for example, the Nifty was up 36%. The mid cap index was up 35% and the small cap index was up 62%. So after such a stellar return in 2005, one would have expected that 2006 would be a much milder year in terms of returns, right? However, people would be interested to know that in 2006, the Nifty returned 40%, the mid cap index was up 29%. And the small cap index was up 42%. This is after the kind of returns we saw in 2005. But more interestingly, the year after that, that is 2007, the Nifty again rose 55%. The mid cap index was up a staggering 77% and the small cap index was up 87%. You had 3 consecutive years of very large returns across large, mid and small. Now, I'm not saying that this will repeat, but I'm also saying that just because you had a good double-digit year return means nothing what the subsequent years could turn out to be. And I think here I'd like to make a differentiation, and which is what we've been saying every month, that while there are a lot of narratives about why we are in such a strong bull market, the strongest narrative has been that earnings growth has been phenomenal. And if you look at the data from the fiscal year ending March 2020 And if you look at the first half, and if I were to just annualize the first half for the full year, March 2024, so let's say 4 financial years, the markets have compounded at 28% from then to now, but earnings have compounded at 38% a year. CAGR. And this is for the top 500 companies. So I'm not talking about a very small universe of companies, I'm talking about the top 500 companies. So I think the fact that we have been consistently bullish about the markets is because the most strongest underlying factor is earnings, and I think the earnings growth is strong. And as I mentioned earlier, 2003 to 2008, one of the landmark things that happened was that earnings compounded at strong double digits. So unless there are events this year which bring into question earnings growth, or if earnings were to falter, then maybe you could put this bull market in question. Otherwise, just because we've had a great year really doesn't mean that we can't have a couple of other great years going forward.
That's actually brilliant, because if you look back to calendar years 2005 to 2007, there were subsequent years of really good returns. Yeah, so we are indeed in a bull market is something that we've been saying across in all our videos as well.
Yes.
Another fear that most market participants and investors have in their mind, Alok, has been on the small cap index and also valuations there. Do you think valuations have moved out of your comfort zone? And when you're allocating funds, are you looking at, how are you allocating between large caps, mid caps and small caps?
Hi Himani, let's look at the data in this context. So obviously this question first comes from the fact that last year was a stellar year for mid and small caps. Then look at the valuation. When we look at small cap index valuation, they are trading at 21 times on 1 year forward basis, which is about 34% premium to the historical averages. Still around 8 to 10% below their peak that we saw 2 years ago. Ditto for mid caps. And they're trading at 28 times on 1 year forward, again 35% premium to 10 year averages. This is what is putting question mark in the minds of the people. Let's look at 2 or 3 other aspects as well. First one being, last stellar rally in mid and small caps happened in 2017. In the last 6 years, Nifty is up 125%, mid cap is up 134%, but small cap is up only 79%. So we cannot be too myopic around it, we have to invert and look at the larger picture. Second important data, if you look at the Nifty mid-small index, which is 400 companies, around 7% of them have reported losses in the last 12 months. This number was nearly 12% 3 years ago. So the number of loss-making companies is also coming down for various reasons. Obviously, a lot of policy initiatives are there, and there's a lot of broad basing of the earnings as well. And the third important part being, the contributors to the profit growth has been changing dramatically. Coincidentally, most of the high valuation sectors are the ones which are struggling for growth. The real growth is coming from sectors which are actually low on valuation for various reasons. So as far as our portfolio picking and positioning is concerned, we are not really bothered about large, mid, small valuations. We look for companies and sectors with higher certainty of earnings growth, and we are not putting too much of our resilience or too much of our reliance on the past data only. So earnings visibility being strong, valuations not too commanding. If that number is in, those companies are in small and mid cap space, we build our positions there.
So basically, a lot of the sectors are already out of the small cap index. That's one point to take home. And the other point is that we are bottom up pickers. So wherever we see growth at reasonable price, that's where we will look to invest in.
Sure.
Interesting. Another question that comes to my mind is, and a lot of friends, family, investors also have, is what are the sectors you think can be the sectors for 2024 Hiren?
So if you see, Himani, as we've been saying, that every bull market has a new set of leaders, and I think clearly the more domestic, so-called cyclical or investment driven sectors are at the forefront of this rally. So whether it is capital goods, whether it is real estate, power, infrastructure, cement, renewable energy, electric manufacturing services, defense. I think these sectors have clearly shown, PSU banks, all these sectors have shown very good leadership. And generally, leadership doesn't change so often. If it's a long-term trend, usually leadership will continue. Now, obviously, every sector may go through a phase of consolidation or correction, but I think the sectors that have been leading in this bull market will continue to lead. Having said that, that doesn't mean we won't invest in consumer stocks or IT services. There are always good growth stories in every sector. I think the thing about leadership is that how you position your portfolios. Do you walk the talk? Do you have enough of your portfolios positioned and allocated in the leading sectors? And I think that's what we have tried to do in each of our portfolios, where we have tried to see that we have enough representation of these sectors one way or the other. And then we do bottom-up stock picking in those sectors, and we find the best opportunities and we put there.
A similar question for you, Alok, would be, do you think the sectors of 2023, which led 2023, would be the leaders of 2024, or there will be new sectors emerging?
Himani, taking the data and cues exactly from what Hiren also said, domestic cyclicals are the ones that have led the rally both in terms of price action and earnings growth delivery as well. So it is not just hopes. We are seeing the order inflows coming through, the order book is swelling. A lot of these sectors are actually led by the initiatives by the government. Given the fact that the government has the intent to do and the means because of a stronger balance sheet at the government level, we do expect that this rally in both earnings and price front could have more legs. It may be reminded that all these sectors and subsectors, they are coming after long hiatus of nearly 15 years. They were doing almost nothing for 15 years. We have seen a lot of consolidation and a lot of companies completely getting wiped out in these sectors as well. So who have left are the ones who have managed to weather the storm and the bad times in a right way. And they are the ones who are probably likely to have a higher chance of winning when the orders come through. So to answer it short, yes, we do expect a lot of these sectors and subsectors to continue doing well in 24 as well.
So we remain positive on domestic cyclicals as long as they are quality and they show earnings growth. So the sectors that we do I find interesting and like could be capital goods, our EMS, the EMS space, some of the PSU banks. Those could be actually some of the new PSU banks can be a new emerging sector as well. So another question that comes to my mind, Hiren, is that defense has been a sector we were lucky to pick some good stocks very early on. But for investors who are now getting have missed that sector and are looking to invest now, do you think defense valuations have moved ahead of themselves, or do you see growth in defense companies even from here on?
So I mean, again, defense is one of those leading sectors of this bull market, right? And if you really see what's happening in defense is that at a very broad level, the geopolitical situation is changing around the world, which means that whether we like it or not, every country will have to spend on defense. In India's specific case, India was one of the largest importers of defense, right? Our annual budget is roughly about 6 lakh crores. And about a third of that is what we spend on actual capital equipment. The rest is all revenue expenditure like salaries and so on and so forth. And what was happening was that within that 30%, almost very negligible amount of that was domestic production. Most of it was imported. And I think what this government has done is that they've clearly decided that we need to get more of the stuff manufactured domestically. And I think there is capacity both within some of our leading public sector units which have been leaders in this field, but we also have a great ecosystem of private companies which have great skills in manufacturing, in electronics, in software. And what was lacking was the focus and the policy environment, and I think that has changed. If you look at the last 2 years, the Defence Acquisition Council has 2 back-to-back years given out orders of almost over 2 lakh crores. I think it was 2.3 lakh crores last financial year. This year to date, and there are still 2 months to go, we are already at over 2 lakh crores. So the order book cycle is very strong, and I don't see that changing at all, right? And I think as India finds its place in the world as one of the preeminent powers, one of the defining features of any country which wants to become a global power is that you need to be self-sufficient, and you need to be strong in terms of your capabilities of defense. So I think this is again one of those multi-year themes. There will always be phases when stocks probably sometimes run ahead of themselves, but I don't think that we can start talking about peak valuations for a sector which has more legs and many years to go.
Thank you for that. That's a very interesting observation. That brings me to the other fear that most investors have, which is, elections, central elections being there this year. Should they be waiting to deploy and invest in the markets, or when is a good time to invest? Do you think the first half of the year, given the elections, can be volatile, Alok?
Himani, elections is one of the most discussed topics in the country. So let's segregate the statistics from the political discussion. If we look at statistics, in the last 25 years, we have had 5 central elections. When I calculate the 6-month returns before election date and after the election result date, all 5 of them, 6-month prior returns were positive, 6-month post returns were positive. The 6-month prior returns, the median return was also double digit. The 6 months post return median return was high single digit. So strike rate of nearly 100% if I were to look at pure statistics. Then comes this part, that this particular election is an election where in any case the current government were to come back for the first time in the whole history of our capital markets, we'll have 3 straight terms been given to one party with full majority. In case that were to happen, there could be more of policy continuity rather than any disruption. So multiple things combined, I really don't see any major reason for anybody to be worried about it, both in terms of political discussion, if the recent state elections were anything to go by. Statistics also suggest, and the only upper circuit in our markets happened on an election date as well. So waiting can be really costly.
Given that Alok actually mentioned about election just being the most discussed topic, just like probably US recession was, and we've seen those kind of discussions come up. One fear that most people have is about deployment. Should they be deploying full amount into the markets, or should they stagger it out, and what is it that you would recommend as the deployment strategy in 2024?
My short and clear answer would be that you should deploy if you have the money which you have already allocated for equity. To me, my experience is that if you are convinced that this is a bull market, and we are, then trying to stagger your investments, to my mind, is a suboptimal strategy. The best way to play a bull market is to be fully committed to it, right? And yes, as I mentioned, there could be corrections along the way, but it's better off that you take those corrections in your stride and not try to optimize or time those. However, having said that, we do have the ability where we do take money, we could park that in the liquid fund strategy and then draw upon that and then invest it in a slightly more staggered manner. So I think for investors who feel more comfortable, we do have the ability to do that. But if you were to ask me, how should I be deploying in a bull market? I would say you should be invested and committed as soon as possible.
Thank you. That makes both the strategies possible at our end. So, but deploy now. If you wish to stagger it, that's also an option. So we remain bullish in 2024 as much as bullish we were in 2023. And as the late Mr. Jhunjhunwala used to say, this is the beginning of the mother of all bull markets. And we actually believe so. Stay tuned while we remain invested in you.